My dear students, welcome back to our channel. In this video, I will be explaining second semester subject Financial Accounting as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 1 first important short question is: define bills of exchange. A bill of exchange is a written promise made by one person to pay a certain amount of money to another person on a fixed date. It is mainly used in business for buying and selling goods on credit. There are three main parties. 1. Drawer, the person who makes the bill, seller. 2. Drawee, the person who has to pay, buyer. 3. Payee, the person who receives the money, can be same as drawer. Example: Ravi sells goods worth 10,000 rupee to Suresh on credit. He prepares a bill of exchange asking Suresh to pay 10,000 rupee after 2 months. Suresh accepts it. Now, it becomes a legal promise. Easy trick to remember. Ravi draws, Suresh pays. A bill of exchange is useful because it gives legal proof of the transaction and guarantees payment on a future date. It's a common tool in business transactions. Next important short question is: 2. Define promissory note. A promissory note is a written promise made by one person to another to pay a fixed amount of money on a certain date or on demand. There are two main parties. 1. Maker, the person who promises to pay, borrower. 2. Payee, the person who will receive the money, lender. Example: Ramesh borrows 5,000 rupees from Mohan. He writes a promissory note saying, "I promise to pay 5,000 rupee to Mohan after 1 month." Ramesh signs the note. Now, this note is legal proof that Ramesh has to pay Mohan. Easy trick to remember. Promissory note is equal to personal promise to pay. A promissory note is used in business and personal loans. It helps both parties by giving clear terms and legal security. It is simple, easy to use, and builds trust between borrower and lender. Next important short question is: 3. Explain dishonor of a bill. When the drawee, the person who has to pay, does not pay the amount of the bill on the due date, it is called dishonor of a bill. It means the promise to pay has been broken. Example: Ravi sold goods to Suresh and drew a bill of 10,000 rupees for 2 months. Suresh accepted it. But on the due date, Suresh didn't pay. This is called dishonor of the bill. In this case, the drawer, Ravi, can take legal action, charge noting charges, extra cost for dishonor, ask for a new bill if both agree. Easy trick to remember. Dishonor is equal to due not done. Dishonor of a bill creates problems in trust and future dealings. That's why businesses carefully record these cases and may avoid dealing with such parties again. It also affects creditworthiness in the long run. Next important short question is: 4. Explain the term accommodation bill. An accommodation bill is a bill of exchange made not for a real trade, no sale of goods, but just to help a friend or business partner get money. It is used to borrow money from the bank. Both parties agree to repay the amount later. Example: Ravi needs 20,000 rupee but has no goods to sell. He requests his friend Suresh to accept a bill of 20,000 rupees. Ravi discounts the bill from the bank and gets cash. On the due date, Ravi pays the full amount, not Suresh. This bill is called an accommodation bill because Suresh helped Ravi without any real sale. Easy trick to remember. Accommodation is equal to helping without trade. It is based on trust and friendship, not business. It should be used carefully, as failure to pay on time can affect both parties' credit and reputation. Next important short question is 5. On 1st January 2015, Rav sold goods 10,000 rupees to Jyoti. Half of the payment was made immediately, and for the remaining half Rav drew a bill of exchange upon Jyoti payable after 30 days. Jyoti accepted the bill and returned it to Rav. On the due date, Rav presented the bill to Jyoti and received the payment. Write the journal entries in the books of Rav. Journal entries in the books of Rav. Question summary. Date of sale, 1st January 2015. Goods sold to Jyoti, 10,000 rupees. Half payment, 5,000 rupees, received in cash. Remaining 5,000 rupees settled through bill of exchange for 30 days. Jyoti accepted the bill. On due date, she paid the bill. Step-by-step journal entries. 1. On 1st January 2015, goods sold, half cash received, half on bill. Journal entry. Jyoti ACDR 10,000 rupees. To sales AC 10,000 rupees. Being goods sold to Jyoti. Cash ACDR 5,000 rupees. Bills receivable ACDR 5,000 rupees. To Jyoti AC 10,000 rupees. Being half payment received in cash and half by bill accepted. 2. On 31st January 2015, due date, bill amount received. Journal entry. Cash ACDR 5,000 rupees. To bills receivable AC 5,000 rupees. Being payment received from Jyoti on bill maturity. Easy to remember. First record the sale. Then record the receipt, cash plus bill. Finally, on the due date, cash received for the bill. These entries help Rav track the full transaction, sale, partial payment, and final settlement through the bill. Next Unit 1. Long questions. First important long question is: write the advantages and features of a bill of exchange. What is a bill of exchange? A bill of exchange is a written promise made by one person to pay a fixed amount of money to another person on a certain date. It is commonly used in business when goods are sold on credit. Features of a bill of exchange. 1. Written document. It is always in written form, not verbal. 2. Three parties involved. Drawer who makes the bill, seller. Drawee who accepts the bill, buyer. Pay who receives the money, can be the drawer or someone else. 3. Fixed amount and date. It clearly mentions the amount and the due date of payment. 4. Signature of drawer. Without the drawer's signature, the bill is not valid. 5. Acceptance. The drawee must accept the bill by signing it. 6. Legally enforceable. If payment is not made, legal action can be taken. Advantages of a bill of exchange. 1. Proof of transaction. It serves as written proof that money is to be paid. 2. Helpful in credit sales. It allows sellers to sell goods on credit with safety. 3. Fixes payment date. It avoids confusion about when payment is due. 4. Can be transferred. The bill can be endorsed, transferred to another person. 5. Can get early cash. The drawer can discount the bill with a bank and get immediate money. 6. Builds trust. It creates trust between buyer and seller, as everything is clearly written. Example. Ravi sells goods worth 20,000 rupee to Suresh on credit. He draws a bill payable after 2 months. Suresh accepts it. Ravi now has a written promise from Suresh. If Ravi needs money early, he can discount the bill with a bank. Easy trick to remember. WFLES is equal to written, amount fixed, fixed date, legal, endorsable, signature. Conclusion. A bill of exchange is a safe and smart tool for business. It makes credit transactions smooth, legal, and trustworthy. Next important long question is to explain the difference between bills of exchange and promissory note. Meaning, a bill of exchange is a written order from the seller, drawer, to the buyer, drawee, to pay a certain amount on a specific date. A promissory note is a written promise made by the borrower, maker, to pay a certain amount to the lender, payee. Example. Bill of exchange. Ravi sells goods to Suresh for 10,000 rupees. He draws a bill asking Suresh to pay after 2 months. Suresh accepts the bill. Promissory note. Suresh borrows 10,000 rupees from Ravi and writes, I promise to pay 10,000 rupee to Ravi after 2 months. Key differences. Point. Bill of exchange, promissory note. Type. Order to pay, promise to pay. Parties involved 3. Drawer, drawee, pay to maker, payee. Who creates it? Seller, drawer, borrower, maker. Acceptance needed. Yes, drawee must accept the bill, no acceptance needed. Can be transferred? Yes. Can be endorsed to others? Yes. Can also be endorsed. Legal use used in credit sales, used for loans or borrowing. Easy trick to remember. BOE is equal to bill is equal to order. PN is equal to promissory note is equal to promise. Summary. Bill of exchange is used mostly when goods are sold on credit. The seller asks for payment later. Promissory note is used when someone borrows money and promises to repay it. Both are legal documents and helpful in business to record transactions, build trust, and ensure payment. Understanding the difference helps in using the right document in the right situation. Next important long question is 3. Dinesh owes a sum of 10,000 rupees to Jagdish. On 1st April 2018, he accepted a bill for the amount due for 3 months to Jagdish. Jagdish gets it discounted with his bank on 4th April for 9,700 rupees. On the due date, the bill is dishonored. The bank paid 200 rupees as noting charges. Dinesh then pays 4,000 rupees in cash and accepts a bill of exchange drawn on him for the balance together with 300 rupees as interest. This bill of exchange is for 2 months. On due date, bill is honored. Pass journal entries in the books of Jagdish and Dinesh. Given information. Dinesh owes Jagdish 10,000 rupees. On 1st April 2018, Dinesh accepts a 3-month bill. On 4th April, Jagdish discounts the bill with bank for 9,700 rupees. On the due date, the bill is dishonored, and bank pays 200 rupees as noting charges. Dinesh then pays 4,000 rupee cash and accepts a new bill for the balance plus 300 rupee interest. New bill is for 2 months, and it is honored on due date. Books of Jagdish. 1. 1st April bill accepted by Dinesh. Bills receivable ACDR 10,000 rupees. To Dinesh AC 10,000 rupees. Being bill received from Dinesh for amount due. To 4th April bill discounted with bank. Bank ACDR 9,700 rupees. Discount ACDR 300. To bills receivable AC 10,000 rupees. Being bill discounted with bank. 3. Due date bill dishonored, bank pays noting charges. Dinesh ACDR 10,200 rupees. To bank AC 10,200 rupees. Being dishonor of bill, including 200 rupees noting charges paid by bank. 4. Part payment received 4,000 rupees and new bill accepted with 300 rupee interest. Cash ACDR 4,000 rupees. Bills receivable ACDR 6,500 rupees. To Dinesh AC 10,500 rupees. Being part payment received and new bill accepted for balance plus interest 300 rupees. 5. On due date new bill honored. Bank ACDR 6,500 rupees. To bills receivable AC 6,500 rupees. Being new bill honored on due date. Books of Dinesh. 1. 1st April accepted bill. Jagdish ACDR 10,000 rupees. To bills payable AC 10,000 rupees. Being bill accepted for amount due. 2. On due date bill dishonored, including noting charges. Bills payable ACDR 10,000 rupees. Noting charges ACDR 200. To Jagdish AC 10,200 rupees. Being dishonor of bill and noting charges payable to Jagdish. 3. Part cash paid 4,000 rupees. New bill accepted with 300 rupee interest. Jagdish ACDR 10,200 rupees. To cash AC 4,000 rupees. To bills payable AC 6,500 rupees. To interest AC 300. Being part payment made and new bill accepted with interest. 4. On due date new bill honored. Bills payable ACDR 6,500 rupees. To bank AC 6,500 rupees. Being payment of new bill on due date. Summary for easy memory. Step 1. Old bill accepted. Step 2. Bill discounted. Step 3. Bill dishonored plus charges. Step 4. Part paid plus new bill plus interest. Step 5. New bill paid on time. Next important long question is 4. On 5th January 2017 X drew a bill on Y for 800 rupees payable after 2 months. Y accepted it on 10th January, on the maturity date. Y could not honor his acceptance. Y got it noted and paid 10 rupees as noting charges. Y agreed to accept a new bill payable 2 months after date. He paid noting charges and 16 rupees for interest in cash and his request was carried out. The new bill was paid in due date. Pass journal entries in the books of X and Y. Given information. On 5th January 2017, X draws a bill on Y for 800 rupee payable after 2 months. Y accepts the bill on 10th January 2017. On the maturity date, Y could not pay the bill. Y gets it noted and pays 10 rupees as noting charges. Y then agrees to accept a new bill payable 2 months later and pays 10 rupees, noting charges, plus 16 rupees, interest, in cash. The new bill is paid on the due date. Journal entries in the books of X. 1. 5th January 2017 Drawing of the bill. When X draws the bill for 800 rupees. Bills receivable ACDR 800 rupees. To Y AC 800 rupees. Being bill drawn on Y for 800 rupee payable after 2 months. To 10th January 2017, Y accepts the bill. When Y accepts the bill. Y ACDR 800 rupees. To bills receivable AC 800 rupees. Being Y's acceptance of the bill. 3. Maturity date, bill dishonored and noting charges paid. When the bill is dishonored on maturity and noting charges are paid. Y ACDR 810 rupees. To bills receivable AC 800 rupees. To bank AC 10 rupees. Being bill dishonored and noting charges paid. 4. New bill accepted by Y and paid noting charges plus interest. When Y accepts the new bill and pays noting charges and interest. Bills receivable ACDR 810 rupees. To YAC 810 rupees. Being new bill for 810 rupees created. Cash ACDR 26 rupees. To YAC 26 rupees. Being 10 rupees noting charges and 16 rupee interest paid in cash by Y. 5. New bill paid on the due date. When the new bill is paid by Y. Cash ACDR 810 rupees. To bills receivable AC 810 rupees. Being new bill paid by Y on the due date. Journal entries in the books of Y. 1. 10th January 2017, Y accepts the bill. When Y accepts the bill. Bills payable ACDR 800 rupees. 2x AC 800 rupees. Being bill accepted by Y for 800 rupee payable after 2 months. 2. Maturity date, bill dishonored and noting charges paid. When the bill is dishonored and noting charges are paid. Bills payable ACDR 800 rupees. Noting charges ACDR 10 rupees. 2x AC 810 rupees. Being dishonor of bill and noting charges paid. 3. New bill accepted by Y and paid noting charges plus interest. When Y accepts a new bill and pays 26 rupees, noting charges plus interest. Bills payable ACDR 810 rupees. 2x AC 810 rupees. Being new bill for 810 rupees created. Cash ACDR 26 rupees. 2x AC 26 rupees. Being 10 rupees noting charges and 16 rupee interest paid in cash. 4. New bill paid on the due date. When Y pays the new bill on the due date. Bills payable ACDR 810 rupees. To cash AC 810 rupees. Being new bill paid by Y on the due date. Key points to remember. Dishonor of the bill means not paying on the due date. Noting charges are paid to the bank for the dishonored bill, here 10 rupees. Interest on the new bill is paid by Y, 16 rupees, along with the noting charges. New bill is created for the same amount plus interest, 810 rupees in total. Simple trick to remember. Excess side receives payment and keeps track of bill and dishonor. Y's side pays the bill, accepts a new bill, and handles charges.